Okay, the next item we have on the transactions are that on December 31st, Jake takes a physical count of their inventory and they discover that the actual physical inventory count is actually $291 worth of inventory. If you look, our balance says $321. So we need to account for that $30 difference. So of course what we're going to have to do is now, that's a cost for us. It goes into our cost of goods sold. So this would be an adjusting entry, and it does show that way on the information I sent you. But we go ahead and debit cost of goods sold for the $30. And we're going to credit inventory, right? Because we no longer have that inventory. So those would be the adjusting entries we would make. And our balances are now $291 for inventory, and for our cost of goods sold, $1,573. Now I have totaled all the accounts. I'm going to step out of the way for a moment in case I was in front of anything so you can see it. But now all those accounts have been totaled, and we can move on. We're going to go ahead and do closing entries. I did send you the income statement, the multi-step income statement, and of course we don't have all their expenses. I'm just using the ones we do have. So I was not able to include a section that had non-operating activities because we did not have any. But at least you have a copy of one just so you can use that for reference. And now we'll go ahead and do the closing entries. Okay, next we're going to do closing entries. The first thing we need to do is close our sales revenue. So the way we're going to do that is we're going to go ahead and debit our sales revenue, and we're going to credit income summary. What we're going to have to do then is close out the rest of our accounts. Since they all have a debit balance right now, we're going to need to credit those accounts. So we're going to credit sales return and allowances for 100, sales discount for 54, cost of goods sold for 1,543, and freight out for $50. What we are now going to do is we're going to go ahead and debit income summary for all of those accounts. So we're going to debit income summary for $1,747. So if you added all of these accounts up, that is what you would receive. Right now, our income summary balance is $1,053. So right now, we have a credit balance of $1,053. We are going to go ahead and debit income summary for $1,053. So that account is now zero. And we're going to go ahead and credit J Capital for that $1,053. I have given J Capital a beginning balance of $5,000. So our ending J Capital balance will be $6,053. So what we've done is income summary is zero, our revenue count is zero, and all of these various accounts are all zero. What I want to still go over with you, one more thing I want to go over with you, I'm going to go over our last problem, and I'm not going to go through all the different T accounts for our periodic inventory system, but I do want to go over how we calculate cost of goods sold. So I'm going to put up the appropriate T accounts, and we will go over our cost of goods sold for a periodic inventory system. Okay, first of all, what I want to explain to you, this is to determine cost of goods sold for the periodic inventory system. What we have to do, and I did give you all the journal entries. We're not going to go through all the journal entries we did for perpetual, and there's no homework with periodic. But I just wanted you to see how we determine cost of goods sold in the periodic method. All of these accounts, purchases, purchase return and allowance, purchase discount, freight in, and cost of goods sold, they are temporary accounts. Normal balances, our purchases are debit, purchase return allowance and purchase discount are both credit, freight in is a debit, cost of goods sold is a debit. Our inventory account, of course, is a permanent account. It's on the balance sheet. As a current asset, it appears right under accounts receivable. And we have an ending balance of $291. Remember, we did that physical count at the end of the year, and we had $291 left of any inventory. I'm assuming we had zero beginning. Okay, so let's take this step by step. First of all, you want to know your beginning of the year inventory. Our beginning of the year inventory is zero. Then you have to look at your purchases. Ours were $2,000. What you then need to do is subtract your purchase return and allowances and purchase discounts. They were $200.36 for a total of $236. So if we subtract that from our $2,000, we get net purchases of $1,764. The next thing we want to do is add our freight in. Our freight in is $100, and that will give us our cost of goods purchased. So our cost of goods purchased was $1,864 during the period. Normally what you would do is take your beginning inventory and add it to your cost of goods purchased during the year. In our case, we have zero, so our amount for cost of goods available for sale is the same amount, $1,864. Last thing we have to do is go ahead and subtract our end of year inventory, which is $291, and that gives us our cost of goods sold. So our cost of goods sold is $1,573. And that's all there is to it. Again, I hope this explained it all to you. If you have questions, feel free to call me. And I just wanted to briefly go over the last homework problem. I think that's the only item we may not have covered. For the last homework problem, I just wanted to make it clear how you're going to determine your missing amounts or some missing amounts. You take your sales and subtract sales returns to get your net sales. You subtract cost of goods sold from net sales to get gross profit. You subtract operating expense from gross profit to get your net income. To determine your gross profit ratio, it is your gross profit divided by your net sales. So if we had $100,000 in gross profit and our net sales were $400,000, our gross profit ratio would be 25%. And that's it. Have a good week.